Hello, welcome. My name is Jeffrey Kennedy. I'm the editor of Futures Junctures. Let me just go ahead and begin by saying thank you for joining me tonight. So what we'll go ahead and begin doing is just go ahead and start with, why do people have difficulty trading the wave principle? Whenever I'm on the road and whenever I'm in front of a crowd, I encounter hundreds of people, thousands of people who actually love the wave principle, but have a very, very difficult time trading the wave principle. And the reason why is quite simple. The primary value of the wave principle is that it provides a context for market analysis. Simply put, as it stands, it's not a trading methodology. So, what are we going to be doing tonight? Well, we're going to be taking a look at a few slides on actually how to take that next step with the wave principle and actually make it a trading methodology. So, before we begin, what are some actual key components of a trading system or a trading methodology? You need a specific entry point, specific exit point, trade management, where do your stops go, where are your targets? This is what I want to focus on in this evening, and what we'll start, or where we will begin with tonight's webinar is, what do you need to know before you actually begin trading with the wave principle? Well, first off, how the wave principle improves trading, which waves to trade, Elliott wave trade setups, Elliott wave entry points and protective stops, trade targets, and then putting it actually all together. Let's go ahead and get started. How the wave principle improves trading. And these are actual questions I would like you to actually think about. For example, wave analysis identifies the trend. How does it actually do that? Wave analysis identifies counter trend moves within the trend. How does it do that? It signals the resumption of the trend. It identifies the termination of the trend. It provides high probability objectives and specific points of ruin. From a trading perspective, how does the wave principle actually accomplish all of these things? Well, very simply, wave analysis identifies the trend by means of the impulse or motive wave, the five-wave structure. Five-wave moves denote the direction of the larger trend. It identifies counter-trend moves within the trend by means of the corrective patterns, zigzags, flats, and triangles. It signals the resumption of the trend by the completion of an 8-wave cycle. And what I mean by that is, for example, a 5-wave advance followed by a 3-wave decline. When you have 5 up and 3 down in place, simply put, you have an 8-wave cycle in place. That means that the larger trend is about to resume. It identifies the termination of the trend. How does it do that? Well, actually, that fifth wave lets you know that the upside is limited or the trend is very mature within its progression. And the way you can behave, or the way you can utilize that knowledge from a trading perspective, is raise your protective stops. Maybe take some trades off the table, so to speak. It's an excellent tool with respect to risk management as well. It provides high probability objectives. The way the wave principle actually does this is by means of the Fibonacci sequence, Fibonacci retracements, Fibonacci objectives. And also it provides specific points of ruin. And this is very important. Also, too, with respect to specific points of ruin, that's simply just a fancy way of saying I'm wrong, or I'm wrong on a wave counter, I'm wrong in my analysis. And the wave principle actually does an excellent job with this with respect to the rules and the guidelines. For example, we all know the 3 primary rules with respect to motive waves. Wave 2 cannot retrace more than 100% of wave 1. Wave 3 cannot be the shortest impulse wave of waves 1, 3, or 5. And wave 4 cannot end in the price territory of wave 1. So whenever this type of price action actually happens, what that does is it tells us we're wrong in our analysis. Now, one of the things I think is very important about the wave principle is that, as many of you know, I look at a lot of indicators and oscillators. I've yet to encounter an indicator, an oscillator, that will allow me to know to the tick when my analysis is wrong. The wave principle, on the other hand, does indeed provide that information. Now let's move on. Now what you're going to be seeing in the next few slides here are the actual answers to the questions I just posed. How does wave analysis identify the trend? By means of the 5-wave move, the 5-wave structure. These are trend-defining patterns. Wave analysis identifies counter-trend moves within the trend by means of the corrections, 3-wave moves, zigzags, flats, triangles. Wave analysis signals the resumption of the trend. Again, a complete Elliott wave 8-wave cycle. Wave analysis identifies the termination of the trend by means of the 5th wave. That lets you know that the upside is limited and that the next big move is going to be to the downside. Wave analysis also provides high probability objectives by means of the Fibonacci ratios i.e. via retracements or projections. And again, wave analysis provides specific points of ruin by means of the rules and guidelines. So what are, from a trading perspective, because one thing that's very, very important, and some of you actually may want to take some notes and write this down, there's a big difference between analysis and trading. Thinking like an analyst and thinking like a trader. Now, with respect to the actual trading opportunities that an 8-wave cycle provides, there are 4. Wave 3, Wave 5s, Wave A, and Wave C. Now, the reason why is because those are trending moves. Those are going to be in the direction of the larger trend. And as a trader, I want the wind at my back. For example, if I was going to describe a trade for you, let's say a buy-side trade for Google, well, how likely is that going to be a successful trade or a successful position if all the other major indices are selling off and they're selling off hard? It's a low probability bet. One thing, too, that's very important to remember, too, amateur traders focus on possibilities, what could happen. Professional traders focus on probabilities, what is happening. And that's very important to understand with respect to analysis and trading as well. So what we do when we look at this slide here is recognize that it's the counter trend moves within the trend that allow us to join that larger trend and take advantage of the impulse moves to the upside or to the downside. So we really get to the meat of this presentation with respect to the Elliott Wave entry points protective stop placement guidelines. Now again, these are my these are my entry points and my protective stop placement guidelines, and I've put them together after years of use, and they demonstrate a very conservative approach to trading. Let me begin. With respect to the motive wave or the impulse wave, my entry point on a position from a trading perspective would be a break below the extreme of wave 4 of 5. So if prices fall to the downside, take out the extreme here of wave 4 or 5, then I can assume a short position against the actual high. With respect to an ending diagonal, what I like to do is I like to wait for the break or the penetration of the extreme of wave 4 before taking a position. Now again, these are very conservative trading guidelines. For example, if you're more aggressive, you may want to begin accumulating short positions as wave 5 develops, especially if wave 3 is shorter than wave 1. Because again, if we go back to the rules and guidelines of the wave principle, what we know is that wave 3 can never be the shortest impulse wave of waves 1, 3, or 5. So if wave 3 is shorter than wave 1, then we know wave 5 must be shorter than wave 3. So if prices push beyond that level, we know we're wrong. So again, if you're a very aggressive type trader, then what you may want to do is begin taking on a short position as wave 5 develops with a stop just above the point at which wave 5 becomes shorter than wave 3. Now, if you're moderately aggressive, moderately conservative, you may want to wait for a break of the trend line, which actually connects 2 and 4. But again, I'm much more conservative with my trading style, and I want to see the extreme of wave 4 give way before I actually do anything. With respect to zigzags, I like to see wave B penetrated before I take advantage of anything. Here we have waves A, B, C. What I do is wait for the extreme of wave B to give way, and then at that point, my initial protective stop would go just below the extreme of wave C. Now, if you recall from, I believe it was possibly the December issue of Monthly Futures Junctures, in Trader's Classroom, I wrote about probably the most important trading rule that I applied. And it's very simple. I want the market to commit to me before I commit to the market. For example, if you're pulling out of your driveway or you're pulling out of your subdivision or possibly a shopping center, and there's a car approaching, but that car approaching has its left turn signal on. Say, for example, it's going to take a left-hand turn and you want to pull out and take a left. Whenever you see the turn signal, do you immediately pull out in front of the car? Of course not. What you do is you wait, you see that turn signal, wait for the car to slow down. Better yet, you wait for the wheels of the car that is approaching to begin to turn. In other words, you wait for that car to commit before you pull out in front of it. Simply pulling out in front of a car with its turn signal on is certainly not safe driving. I like to apply that same rule or that same logic to my trade setups, with respect to Elliott wave patterns. Here I have a waves A, B, and C. That's a three-wave move to the downside. But once prices begin to move beyond the extreme of wave B, that's the market showing me its commitment to me or my analysis. And that point, or with that in mind, then I can make a confident commitment to the market with regard to my positions. With respect to a flat pattern, I want to see the extreme of wave 4 of C give way before taking a position. With respect to triangles, I want to wait for wave D to give way, and then at that point put my protective stop at wave E. Now again, the rules and guidelines, or the guidelines I'm showing you here with respect to entry, are very conservative. Some people like to actually take a more aggressive approach to trading, and that's fine. That's simply not me. And what they do is, as wave E unfolds, they'll begin looking to get long down in this point here with a stop right at the extreme of wave C. Well, if you're aggressive in your trading style, and there's nothing wrong with that, it's just, again, it's a personal choice. If you're aggressive in your trading style and you're actually looking to take a position as wave E is culminating, I would recommend, though, that you put your protective stop against the extreme of wave A to prevent just a spike down, maybe a one-tick break of this level, and then move higher. Also, too, remember that a triangle is a very, very tricky wave pattern because a triangle can form by itself in the wave 4 position, wave B, and wave X. So, again, the rules and guidelines I'm showing you are very, very conservative, and certainly not for the aggressive trader. The aggressive trader at this point is most likely getting in as wave E forms. So again, I hope this actually helps out with respect to what I write about daily in futures junctures and how I identify actually key and critical support levels. A lot of those key and critical support levels I identify in futures junctures are derived in this methodology. In other words, if I see, for example, a zigzag, a 535 pattern to the downside, I really want to see the extreme of wave B give way before I begin thinking of it as a viable trading opportunity. If we're working a flat correction, again, at that point, I want to see the extreme of wave 4 of C penetrated before I begin looking at price chart as a viable trading opportunity. Now here, there's simply the targets, the Fibonacci-derived targets for our trending moves, waves 3, waves 5, waves A and C. Now, with that in mind, let's go through a basic checklist of how to put the wave principle to work. And before I start with this list, let me go ahead and give credit where credit is due. This list was I helped a colleague of mine, actually my mentor, Dave Allman, actually helped me put this list together. And it's very, very, very important, and one I've been utilizing for a number of years. You always begin, whenever you're trying to identify a high probability Elliott wave-based trade setup, you want to ask one very, very important question. Do you see a pattern you recognize? At that point, there's a few more questions to ask. What evidence supports my assessment? What is the most likely course prices will travel? What is the best alternate labeling? Where am I wrong? Does the analysis warrant actually taking a position? For example, what are your money management rules? With respect to my own trading, I don't take a position that does not offer at least a 1-to-3 risk-reward ratio. Simply put, if it's 1-to-2, I don't take it. It has to be 1-to-3. That's my rule. That's my risk management rule. You may find with respect to your own risk management rules, you may have a very clear wave pattern, but simply it doesn't warrant taking a position. Where do I enter a position? Well, we've answered those questions this evening. Where do you enter a position? For example, if you have a 5-wave advance followed by a 3-wave decline, which clearly traces out a zigzag, you now know where to actually enter that position. Moreover, you now know specifically where to place the protective stop. And with respect to the Fibonacci multiples that most everyone is aware of, for example, wave C equals the distance traveled in wave A, wave 3 equals a 1.618 multiple of wave 1, wave 5 tends toward equality with wave 1 when wave 3 is extended. Now you have an idea of where to actually be taking these profits, and then how will I actually manage the position once it's open? All of these are good questions, and all of these questions need to be answered to the best of your ability before you actually enter the position. And the reason why is because whenever money is involved, logic goes out the window. What do I mean? Well, I'll share a couple of personal stories with you real quick. For example, the stupidest things I've ever done in my life have always been when I've been in love. And the reason why is because when I'm in love, I'm thinking with my heart, I'm not thinking with my head. From a trading perspective, whenever money's involved, emotions are involved, specifically fear and greed. And that's why it's so important to have a disciplined approach to examining and analyzing and trading the markets, because once that position is actually taken, that's not the time to be answering these very, very important questions. Now let's go on and just take a look at a few examples of actually the application of the wave principle on a few price charts. Okay? Now, who was taking notes? And what I mean by that is, what's the first important question we ask ourselves with respect to identifying a high probability trade setup utilizing the wave principle as our primary tool? Well, the question is, do you see a pattern you recognize? When you look at this price chart here, do you see a pattern you recognize? Simple question. Okay, if you see a pattern you recognize when you look at this price chart, that means you potentially have a trade. If you do not see a pattern you recognize, then that simply means you go on to a different market or stock or equity or bond or commodity. There's nothing good about that. There's nothing bad about that. That simply is an is. I see a pattern I recognize, so I'm going to buy 5 Treasury notes at 112.15. Well, why 112.15? Because if you look within this structure here to the downside, we have waves 1, 2, 3. I believe this is the extreme of wave 4, 5 down in wave C. In other words, I have a 7-wave move. This is basically an ABCX, ABC. More accurately, this is a WXY formation. But again, just because I have a completed wave count down here doesn't mean I immediately jump in on the market. I want the market to commit to me before I commit to the market, and that commitment level in this instance is a move through 112.15. Let's see what happens. Well, the market moves up, it moves through 112.15, and ideally prices are going to continue to push higher here. My protective stop at this point is 111.16. Market moves a little bit higher, and each day with each price bar it's continuing to confirm my analysis, which is the strongest position to be analytically as well as from a trading perspective. And as the market moves up, I move my protective stops up, typically to either an Elliott wave pivot point or a prior swing high or low. As the market moves up, I continue to evolve my wave count to the upside. I believe what we have in this situation here is 1, 2, 3, 4, and 5. And as the market moves up, I move my protective stop up. Now at this point, because again, if you go back to some of the things that we were speaking about earlier, what you'll remember is how does the wave principle let me know that the end is near, so to speak? It's that 5th wave. That 5th wave move is the final move within a sequence prior to the next significant move, which is going to be in the opposite direction. So again, that allows me to tighten my protective stops up and move them up a bit higher. At this point, I'm moving my stop up to 114.21. I have a sell order in at 115.15. And as you can see, the objective was hit. I'm out of the market. And this was a very nice trade. But remember, what was the genesis of this entire position to begin with? It began with one simple question. It began with, do I see a pattern I recognize? Now, it's very important to remember the primary value of the wave principle is that it provides a context for market action. Let me say that again. The primary value of the wave principle is that it provides a context for price action. Very important. Let me say that one more time because I'm going to make a very, very important distinction here that's very valuable to traders who utilize the wave principle. The primary value of the wave principle is that it provides a context for market action. When it comes to trading the wave principle, I focus primarily on the 5 primary Elliott wave patterns: impulse waves, ending diagonals, zigzags, flats, triangles. And the reason why is because those patterns do not change. As new price action comes onto the price chart, that puts past price action into context and sometimes into a new context. However, wave patterns, if correctly identified, a zigzag today is going to be a zigzag tomorrow, and it's going to be a zigzag 10 years from now. However, the context of that zigzag may change as appropriate or more price action begins to filter in from the right-hand side of your screen. Let's take a look at another example. Where do I always begin? Do you see a pattern you recognize? Well, I see a pattern I recognize, so this is what I'm going to do. I'm going to buy 5. This is the mini Dow. I'm going to buy 5 contracts on a break of 1310. Notice here, here's my wave count. Notice that I'm not immediately jumping into the market. I want the market to prove itself before I do anything. Again, go back to the example of what I shared with you with respect to the blinker and the car. Just because I see a left-hand turn blinker on a car is not a good reason to pull out in front of a speeding car. You want to see the car slow down. You want to see the wheels turn. That's what I want to see from a financial market or a potential trade setup. Well, again, this is the larger context, which is so valuable that the wave principle does indeed provide. If we go back here to the prior slide, I see a 5-wave move down. What do I expect the prices to do? Of course I expect them to move up. I expect them to move up to the previous 4th wave extreme of 1 lesser degree. Just an Elliott wave guideline with respect to the depth of corrective waves. When viewed in context, I can actually put my objective higher at 1307. Well, here was the trade I actually outlined. I got in at 1310. Currently, my protective stop's at 1330.06. Let's see what happened. I got stopped out. It was still a profitable trade. But moreover, let me go ahead and bring aspect of this price chart. Notice that I didn't buy right here. Also, too, notice I didn't sell right here. Many people, many new traders, want to do just that. They like to get in right at the low, and they like to get in right at the high. Well, if you think about that just for a moment, the probability, again, remember I said earlier that amateur traders trade possibility, yet professional traders trade probabilities? Well, let's examine that. The probability of actually buying, in this instance, bottom tick and selling top tick is extremely low, probably 0.0000999. But the probability of capturing 60 to 80% of a trending move is much, much higher. And that's my objective as a trader. And as you can see in this instance, it was indeed a profitable position. Now let's go back. Here's again the larger context that the wave principle provides. Here's my initial 5-wave move up. As you can see, I'm working a running triangle. I'm looking for a move down and then another move back up. Let's see what happens. Here's my here's the short-term interpretation. This is a 15-minute price chart. Here's my 1, 2, 3, triangle 4, 5. Here's my 3-wave decline. Via the larger context that the wave principle is providing, I see that there's another move to the upside likely. So that's my strategy. That's my trade strategy. I want to buy 5 more contracts on a rally through 1343.2. Well, again, why am I not buying right down here where I think wave C ended? Because again, I always want the market to commit to me before I commit to the market. And as you can see in the following day, prices pushed up higher. We went through my entry level and they continue to go higher. As prices move up, I move my protective stop up. Now at this point of the trade or of the position, I put in an order here, exit on close. Why would I do that? Well, primarily because this was a Friday. I didn't want to hold a position over the weekend, and I did my job as a trader. Trading is a business, and my mission statement as a trader and running a business is to do one thing: make the cash register ring. In this instance, I did. Did I get bottom tick and sell top tick? No, that's not my goal. My goal was to capture 60 to 80% of a trend. That I know I can do with a high degree of certainty. So that's what I focus on. Simply put, in this instance here, it was a profitable trade at that point. I simply did not want to hold a position over the weekend, so I exited the market on close, and again, very, very profitable. Now let's go back to our larger context that the wave principle does indeed provide, and is extremely valuable. Well, again, I'm working my running triangle here, which, as you know, a triangle is a sideways pattern where each wave subdivides into 3 smaller waves. As you can see in this instance, I believe wave D to the upside is complete 535. So now my next move, or my next likely course of outcome in this instance, is going to be a move to the downside. So let's begin trying to formulate a trade plan. I've got an initial move down here, a little ABC move up, and again, noticing that I'm not immediately just jumping in on the market. I want the market to commit to me before I commit to the market. That's why my order is in place right below 1362, which is the extreme of wave B in this instance. And as prices move down, I'm filled on the position. I'm short 5 contracts. My protective stop's 1365. Well, what do you see when you look at this slide here? Well, we have an ABC. What about this price action right here? Is there anything really impulsive about this price action? And I hope everyone says no, there's not. Simply because you basically have an up move, sideways consolidation, followed by an up move. I suspect it's an X wave, which is why I label it a wave X, but I also recognize from a trading perspective that the market is giving me potentially another opportunity to go to sell another 5 contracts, which is why you see the sell order here, sell 5 at 1350. In other words, the market's giving me another opportunity I want to take advantage of as a trader. Simply put, A, B, C, X, and then we push lower. As you can see, I'm filled on the position, and the market does indeed push lower. At this point, I begin putting out objectives, downside objectives, the Fibonacci objectives we spoke about earlier. And finally, the position's exited. And this has been basically over the span of about 2 weeks, 3 very nice short-term trades. And all along, what did I really do? I focused on the rules and guidelines of the wave principle. I focused on the 5 basic patterns: impulse waves, ending diagonals, zigzags, flats, and triangles. And also, too, I did pay heedance to the context that the wave principle provided basis the larger daily price chart. Very simple stuff. Let's look at another example here. This is mini gold. Okay, where do I always begin? I ask one very important question regardless of what market or what price chart or what time frame when I'm looking for a trading opportunity. Do you see a pattern you recognize? And just pause for a moment. I can't really pause because this is a live webinar. But if just pause for a moment and look at this price chart and tell me, what pattern do you see? Look at it initially from an analytical perspective, as an Elliottician. Then, I'm challenging you, look at it from a trading perspective. Well, I'll kind of move ahead here. I see a triangle. What do we know about triangles? Well, triangles can be 4th waves. That's typically where they occur. But they can also be B waves, and they can also be X waves. This is a viable Elliott wave count. Well, if so, you know where my entry point is via my guidelines that we covered earlier this evening. I want to see the extreme of wave D give way before I take a buy-side position. Here's my order. I'm going to buy 5 mini gold at 825 with a protective stop at 788.1. But again, remember, triangles can be very, very tricky. Here's a pattern, here's a identification of the same price action, which is equally viable. Remember, triangles can occur by themselves as waves 4, waves B, and waves X. So this is an equally viable interpretation. How do we handle that? Well, the market could go up, the market could go down. How do you handle that kind of a situation as a trader? Very simply. Who says you can't have 2 trading strategies in place? In this instance, I have a buy-side trading strategy implemented. If the market goes above 825, I'm long 5 contracts. If the market sells off sells off below 780, I'm short 5. Here's my trade plan. Again, what you have to remember is that analysis and trading are 2 totally separate skills. What you're going to have to do when you look at these price charts is, number 1, look at them from an analyst's point of view. What could happen? What's happening? What are the alternatives? What makes the most sense? Then you have to take that knowledge and take the next step and think of it as a trader. You have to think about risk reward, position size. Again, trading is a business. That's when you have to put your business hat on and begin thinking along those lines, which we will quickly find out, and I'm sure many of you already know, it can and is a challenge at times. So in this instance here, simply put, and very honestly, I don't know if the market's going to break up. I don't know if the market's going to break down. Either way, I do have a viable trade strategy in place for either scenario. And as you can see, the market does indeed break up. I've got triggered at 825. My protective stop initially goes at 79.7.1. And as you can see in the subsequent days, the market continued to follow the path as expected. Very, very important. And as you can see, again, as the market moves up, I move my protective stop up. Finally, I begin having some upside objectives. I got stopped out. Nice little trade. Very, very nice. But again, let's go back to, again, the genesis of each example that we've looked at thus far. What was the genesis? Where did it all begin? It all began with one very important question. Do I see a pattern I recognize? What patterns am I referring to? I'm referring to impulse waves. I'm referring to ending diagonals. I'm referring to zigzags and flats and triangles. And then once I see that, that's when I take that analytical hat off, and that's when I put the trading hat on and begin to go, okay, well, what's my risk-reward ratio on this position? Is it actually worth me risking my money? At what point is needed to give way for this market to have committed to me before I commit to the market? Very simple stuff. Let's take a look at a few more examples. This is silver. Now, this example here, I think, is probably the most valuable and most important example within tonight's or this evening's webinar. So I know some of you probably have things to do like dinner to cook. If you could, just hang with me probably about another 5 minutes, because this example in silver, again, I think is probably one of the most important examples in tonight's webinar. What do you see here? Do you see a pattern you recognize? Well, I do. And this is what I see. I see a 5-wave decline followed by a 3-wave counter trend move to the upside. I see a wonderful shorting opportunity. Look at the substructure. 1, 2, 1, 2, 3, 4, 5 for 3, 4, 5. That could be A or 1. Doesn't really matter because I know we're going to be falling below $12 an ounce here. And then I have A up, B down, expanded flat in the wave B position, followed by a wave C advance. This looks like a no-brainer. I'm so excited about this. And I would suspect many of you, now that I've actually gone through the subdivisions, would actually agree. Many times when I actually put this example on the screen, when I actually teach seminars real time to crowds of 20, 30, and 40 people, usually I have everyone's agreement. Let's take a look what happens. Oh, here's my trade strategy. I'm going to sell 10 initially on a break of 14.45, and then I'm going to sell another 10 on a break of 14.05. Well, I got triggered on my first 10 at 14.45, so now at this point I'm excited. 1 down, 2 up. Oh, should be a huge third to the downside. Push a little bit lower. I'm excited. Again, I'm short 10, looking to go short another 10. Ouch. This is why this slide, this example, silver, is probably the most important example out of everything I'm showing you tonight. If you trade, you can and will lose money. This is why psychology is so important. This is why discipline is so important. This is why money management rules are so important. And this is why it's so important to let the market commit to you before you commit to the market. What happened in this instance? Well, I can tell you exactly what I did wrong in this instance. Number one, my ego was involved. I was getting ready for a seminar, and I wanted to put together an example for my attendees that showed them how brilliant of an analyst I was and how good of a trader I was. So my actual rule, my guidelines that we discussed earlier, the actual rule for entry in this instance would have been a break of 14.05, not 14.45. But because I wanted to impress my next batch of seminar students, I was more aggressive than I normally am. In other words, the entry was in here at 14.45. I should have had the order in at 14.05. Also, too, the size was out of proportion. I should have been trading 5 here and 5 here. Simply put, my ego is what did me wrong in this instance. Also, too, it prevented me from hearing and seeing the true story of what the market has to say. For example, look at this advance from this low all the way up to here. Subdivides nicely as a 5-wave move, but the personality of this move is all wrong. for wave C of a counter trend move. In this instance, I'm calling this a zigzag. This move, the slope, the angle of ascent in this move is actually sharper than what we initially saw. Now, if you recall, with respect to, say, the angle of ascent, the slope of a third wave, that actually should be sharper than what we see in wave 1. But with respect to wave C, and certainly wave C within a zigzag, you actually want to see the slope be more shallow, i.e., say, in this instance, demonstrating overwhelming selling pressure. All the clues were already on this price chart and why this was not a good short position. My ego got involved, and I didn't hear the story the market had to say. The evidence, the data on why this was not a good position was all right here. I just chose to ignore it because I wanted to be a hero. Moreover, I actually abandoned my own trading rules, and it cost dearly. Let's take a look at a few more things. Australian dollar. Now, I'm actually going to be quiet for a moment. Yes, I can be quiet. What I would like to do at this point in tonight's webinar, you're looking at a price chart. This is a daily price chart of the Australian dollar. And I'll be quiet for a few moments, but what I would like to do is actually challenge you to complete an exercise with me. What I would like you to do is label this price chart as an Elliotian, from an Elliott wave perspective. Identify the operative wave pattern. Once you do that, I want you to outline or sketch out a viable trade plan. Where are you going to get in, where your initial protective stop is going to be, and where do you expect the market to go? Because that's really where the rubber meets the road. Knowledge is powerful, but really knowledge and action is what's most powerful. So again, take a few minutes, identify this wave pattern here from an Elliott wave perspective, and then take that next step, because again, that's where the rubber meets the road, and formulate or outline just a basic trade strategy. Where are you going to get in, where your initial protective stop is going to be, and then where do you expect prices to go. I would like you to participate, and then at the end, I'll show you what I did. Well, I'll go ahead and begin back. I'm sure some of you have already finished the exercise, and I'm sure some of you are still working on it. And there's probably one or two of you going, well, I'd like to see more data, or I'd like to see volume, or maybe I'd like to see an indicator or two. I'll talk about that momentarily. I have fun with this example whenever I show this at my seminars, because of the variety of different wave counts I get whenever I challenge people to identify this price chart from a wave perspective. The most basic read of this price chart is basically that you have a move down that kind of looks like a 3, so we'll call it a wave A. This move back up ends at or near the origin of the move, so likely we're working a flat structure. Then we kind of have something to the downside that's fairly impulsive. We'll just go with a very simple wave count, A, B, and C. Or you could be a little bit more, I guess I would say, structurally correct and say, okay, we have ABC for W. This would be an X wave, and then we have another ABC for a Y, so that would be WXY. That also works. Some of you may be thinking that this is wave A down, and this is actually a good lesson. If this is, say, A down, then this would be A, B, C to the upside, in which case you only push a bit higher and then fall. I've actually seen someone use an expanding triangle interpretation, which actually does fit A, B, C, D, E, and then again 1, 2. Regardless of actually how you identified the wave pattern here, I hope, number one, you didn't begin to identify the structure off the high as an impulse wave or a motive wave, a trend-defining move, because it's not. It's slow, it's choppy, it's sloppy. This is a corrective structure. That being the case, the larger trend is to the upside. Okay, that being the case, my path, or the way I chose to handle this situation, was to simply buy the market. And the reason why is because this is a very bullish price bar. As you know, with respect to futures junctures, I do a lot of individual and multi-bar price analysis. This is a very impulsive or a very bullish price bar where the bulls are in total control of the market, which is why I'm basically buying 5 at the market with a stop just below the low of the bar. Okay, what if your interpretation was different? What if you were thinking this is going to be a wave C of B up and then down? Well, if you utilize that rule that you want the market to commit to you before you commit to the market, even if you had a different interpretation where you were looking down rather than up, that rule would have kept you out of the market and basically still waiting. In other words, it didn't cost you any money. Simply put, I think it's either, regardless of how you want to count it, because all 3 interpretations work, WXY, ABC, expanding triangle. Bottom line, this is not an impulsive move. I certainly have an impulsive move up and a pullback. I like the buy side here. And as you can see, this is what I'm looking for. This is what I'm expecting. And as the days unfold, this is exactly what happened. Very simple and very, very nice. Also, too, with respect to this example, let me focus your attention on a few very key things. None of the examples that we've looked at this evening did we really fluctuate from, okay, this is a daily price chart, let's look at what the intraday structure is. We certainly didn't do that with this Australian dollar example. I wasn't looking at a daily price chart and looking at, okay, what's the weekly pattern? I was basically looking at a single price chart and trying to, again, answer that most important question. Do I see a pattern I recognize? And then from there, I would put my trading hat on and begin to formulate a viable trade strategy that adhered to my money management rules and my trading discipline. Now, it's very important to basically go ahead and tell you right now that when I do teach, I think it's very important to touch on 2 aspects that I have yet to really speak about this evening. What I've shown you right now, I really believe is a step in the right direction toward becoming a consistently successful trader. But this is, even though this is putting you in the right direction, again, having rules and guidelines that actually show you when to get in, when to get out, and actually how to enter an Elliott wave-based trade, it's only one portion of a 3-part equation. The other 2 parts that I don't have time to talk about, but I do mention in my seminars, are the importance of psychology, your psychology and discipline, and money management. In fact, though I break it down in my seminars, I basically say the successful trade is broken down into 3 parts. 60% of that is psychology, your own individual psychology. 30% is money management. 10%, that's the actual technique, and that's what we spoke about this evening. Discipline is very important, and your own personal psychology is very, very important. In fact, 2 authors which I would definitely recommend to anyone are Mark Douglas. He's an excellent author. He has written a book called Trading in the Zone, or The Disciplined Trader, and he actually talks about the what goes on in your head. The psychology of being a consistently successful trader. Very important book. I wish I got a kickback whenever I recommend it, but I don't. It's a great, great book. And anything by an author by the name of Van Tharp. Excellent psychologist that basically deals with respect to the psychology of trading. Money management, that's a whole new ballgame there. I do have my own money management rules that I tend to follow, and 1 to 3 risk-reward ratio is an excellent, excellent place to start. Also, 2, I wouldn't recommend trading or putting any more than, say, 3 to 5% of your portfolio in any given position. Now, I will say that, okay, if you're short soybeans and short corn and short wheat and short soybean meal, no, that's not 4 separate positions. That's basically 1 position, because if soybeans, corn, and wheat go down, everything's going down. But again, psychology is very, very important to trading, your own individual psychology. And the reason so is because whenever money's involved, fear and greed are involved. So you have to get a handle on that. And the way you get a handle on that is by having a very, very well-defined trading methodology, very disciplined way of looking at the market, and then the maturity to actually stick to it. Now also too, because I'm getting ready to actually wrap the evening up, and I would like to say before I wrap things up, I really appreciate everybody joining me tonight. I hope you found some value in what I actually showed you, but this is the type of stuff I teach when I'm on the road. It's taking that next step from this is the wave principle from an analytical perspective. Taking that next step, how do you apply it? How do you apply it in such a way where the probabilities of success are indeed in your favor? Because that's essentially what a technician or an Elliottician or a technical analyst actually does. We simply evaluate probabilities. That about does it for tonight. Now, before I leave, though, because I still see I have quite a few people in the room, at this point, I would like to, if anybody has a question, hey, I'm here all night. So, well, not all night. I'll be here for the next 10 or 15 minutes. So if you have a question, go ahead and type them in real quick, and I'll see if I can maybe clarify a point that I may not have been clear about earlier on. No questions? Okay. Okay. Hold on. I found all the questions. Okay, let me see if I can, give me a minute to catch up. Okay. Okay. Here's a few questions I would like to pick up. Okay. Here's a question here. How do you move the stops once you are in a trade? Excellent question. Well, number one, I would actually focus primarily on the key Elliott wave points. For example, wave 4 should not fall into the price territory of wave 1. So that wave 1 extreme is going to be a key Elliott wave point. Wave 2 can't fall below the origin of wave 1. So the origin of wave 1 is also going to be a key Elliott wave point. As soon as prices move above the extreme of what I would believe to be a third wave, then the extreme of that fourth wave would be another key Elliott wave point that I would probably utilize as a stop. Once prices do exceed the extreme of wave 3, most likely I would move down to a smaller time frame and try and begin to work on those smaller pivots. With respect to futures, junctures, and analysis, you've seen me do what I call trend analysis, where I focus primarily on what I call the key pivots, key support, critical support. Those are some levels that I also too use. Now also too, I would like to go ahead and just bring your attention to something that you may have missed throughout tonight's presentation. We're at the bottom of the price charts that you saw. Did you see volume? Did you see indicators and oscillators? Did you see stochastics? Did you see MACD? No, you didn't. All you basically saw, all I was essentially doing was focusing on very clear, almost textbook quality wave patterns, the implementation of Elliott wave rules and guidelines, and then taking the next step, looking at them as a trader, as a business person, with respect to where do I get in, where do I get out, and again, actually how to manage the stops along the way. So with respect to trade management, how you behave once a position is actually initiated, I would utilize the key Elliott wave points, the key and critical Elliott wave points within the subdivisions as prices either move up or move down. Let me see. Would you use these same guidelines at, okay, the question is, would you use these same guidelines at 5-minute intervals? The answer is most certainly yes. I use these same guidelines because on occasion I do day trade E-mini contracts. And the same rules and guidelines that I shared with you tonight is exactly those same rules and guidelines I employ on a 1-minute price chart of the E-mini Dow. Yes, the answer to that is yes. And I see some friends here that I've actually met overseas in Europe as well as in Australia. Thank you for coming. Let me see. Okay, here's a question with respect to one of the examples that we were looking at earlier. Someone basically wrote in and said that they didn't see a tradable pattern. That's okay. Let me just say that again. If you look at a price chart and you do not see a pattern you recognize, that's okay. One thing I would strongly urge you to do as analysts and as traders is to get away or lose the emotionality with respect to the words right and wrong. Okay? If you do not see a pattern you recognize, that's not good, that's not bad, that simply just is. It simply means that you'll simply look at another market where you might see a pattern you do recognize. Don't push it. That's a great way to lose a lot of money really, really quick. Again, I've had positions or taken trades where my analysis has been perfect, yet I've lost money. And then I've had situations where my wave count was all wrong and I made money. Right and wrong, yes and no, those really have nothing to do with trading from my experience. And again, if you can get away from the emotionality of yes and no, I certainly recommend doing that. Okay, let me see. I'll get a couple more questions here. Yes, this works on an intraday basis. What charting software? That's always a good one. What charting software do you use? I use CQG, Commodity Quote Graphics. It's probably the industry standard among professionals, but there's a lot of different formats out there. If you're not doing, say, high-speed intraday day trading analysis on 1, 2, 3-minute price charts, then there's a lot of free price charts on the web. I think there's actually a website called freepricecharts.com. Yahoo Finance is a great place to get end-of-day data or end-of-day price charts that I think are more than adequate for most people who say do not trade professionally or do not trade or that active. Simply put, looking at price charts once a week on the weekend, which is what I do many times, is I'll go through about 200 or 300 price charts over the weekend and pull out maybe 3 or 5 that look really, really exciting, and that's what I'll focus on the following week. Let me see. Here's a question. I'll do my best to answer it. Would you say that moving average crosses are a good confirmation of trading points? For example, a 3-period exponential moving average crossover versus a 6-period exponential moving crossover. I don't know. I've done a lot of work with moving averages, and with respect to crossovers and moving averages, it's important to understand that with respect to a moving average, it's always going to actually lag price. Now, the way some technicians kind of get around that lag in price is instead of using a simple moving average, they'll use an exponential moving average or possibly even a weighted moving average. I've done a lot of study and a lot of back testing with different types of moving average crossover systems, double, triple, single. I would just recommend keeping it simple. For example, a 10-period simple moving average. If prices close above or below a 10 simple period moving average, in many instances that can be very, very telling, especially if corroborated by a solid Elliott wave count behind it. What I do recommend, keep it simple, and whatever you do, be consistent. Don't use, say, for 1 week, a 10-period simple moving average, and then the next week, a 3-period, 6-period EMA cross. And then the following week, maybe you go to something different. Be consistent. That's the only way to really learn whatever indicator that you do use. Here's a good question. Do you ever use an automatic trailing stop instead of ratcheting it up step by step to key levels? No, I do not use an automatic trailing stops. I am familiar with a few automatic trailing stop techniques, such as parabolic. Parabolic was developed by a gentleman by the name of Welles Wilder, brilliant analyst, by the way. And there's a few techniques that he actually put together with regard to trade management. Again, it's called a parabolic. And the other one is a volatility stop. Both I've worked with, and both I think indeed have merit. So if you're looking for an automatic trailing stop technique, I would recommend much of or a lot of Welles Wilder's work. In fact, many of you may not know this, but he's actually the guy behind relative strength, RSI, the relative strength index. Is there a way that trend lines can determine the Elliott wave pattern? This is a real good question because it kind of speaks to my heart. Is there a way that trend lines can determine the Elliott wave pattern? Yes, there is. And I've actually done a webinar on trend lines and trend line usages or use that actually allows you to identify the difference between corrective waves and motive waves. I believe the name of the webinar is called Trading the Line. I actually show you my own, I call it a channeling technique that I developed about 10 years ago that's very, very good and actually differentiating between the difference between corrective waves and impulse waves. So if you're really not up to speed on identifying the subtle nuances of each individual pattern, the trendline technique, the channeling technique that I show you in my work will definitely put you in the right direction. Would it be possible to post book references, books that I like and I recommend? Let me put some thought behind that. There's a handful of books out there that I would recommend, and most likely, again, I would start with anything written by Mark Douglas or Van Tharp. Excellent books on the psychology of trading. Again, when it comes to actual trading, 60% of it is psychology. 30% is money management, and there's a few books I can recommend with respect to money management, and then 10% is actual technique. Do I prefer 30-minute, 60-minute, or daily price bars to ID a pattern? Excellent question. The question is, do I prefer 30-minute, 60-minute, or daily price bars to ID a pattern? It depends on my trading time frame. For example, excuse me, if I come in the morning and I feel like taking a day trade or taking a shot at the market for a couple of $100 move, I'll most likely focus on simply a 5-minute price chart. If I don't have the time, if it's a busy week, say it's a newsletter week, but I see something developing bigger picture in the markets that I may want to try and kind of position myself for, then I focus primarily on the daily. Now, as editor of Futures Junctures, I do have a very strict regime that I actually follow. I always look at the weekly price charts to identify trend. And then I go to the daily price charts to identify a viable pattern. And then from that point, I like to move down to the intraday time frame, anywhere from say 60-minute to 240-minute price chart, to get the clarification of the wave patterns and begin to identify those levels which I consider to be key and or critical. Here's a good question. Do you make more money by taking a slice out of a wave by focusing on the trending move, or by buying put or call options? Okay, with respect to that, options are a very complicated trading vehicle. You have primarily the Greeks, which actually are very complicated, and that's let me see, gamma, delta, alpha, rho, a number of there's options trading is very, very complicated. I'm certainly not an expert options trader by any means. I know what a put is, I know what a call is, and that's about the extent of my options knowledge. However, Wayne Gorman, the individual that I teach with, he is an expert options trader, and he's done some phenomenal work with options and the wave principle. If you're really interested about options, and you're really excited about the wave principle, I know I am. I'm actually more of a believer in the wave principle now after 15 years than I ever have been. But if you're excited about the wave principle and you really want to know learn how to take advantage of it from an options perspective, Wayne Gorman is your guy. Simply go to the ElliottWave.com website, go to the store, and what you'll find are a number of webinars that he's put together which actually deal specifically with options and the wave principle. Here's a question. Next time I analyze cocoa, can I take a look at London cocoa? I'll do my best to actually facilitate that. That's about it for the questions. Again, let me just say that I really do appreciate the time that you chose to spend with me this evening. I really do appreciate it. I hope you've enjoyed the webinar tonight and got a real good feel of the other side of the equation, i.e. going from analytical side, Elliottian portion or point of view, to the actual trading point of view. And I hope showing you a number of examples was very, very helpful. Again, thank you so much for joining me tonight, and I hope you have a great evening. Bye-bye.